While my video series 76 part 3, we have already completed our discussion on shareholders funds and non-current liability. Today, while this video series 77, let us start our discussion on current liabilities. The current liabilities are further divided into 1. Short-term borrowing, 2. Trade payables, 3. Other current liabilities, and 4. Short-term provisions. In simple terms, any liability which need to be paid within a period of 12 months from the date of balance sheet is called as current liability. Suppose the balance sheet is known as on 31/3/2020. Any liability which need to be paid on or before 31/3/2021 is a current liability. Now, Schedule 3 of the Companies Act defines current liability as 1. A liability shall be classified as a current liability when it satisfies any of the following criteria. Need not satisfy all the criteria, any of the following. One of the conditions, if it is satisfied, that item can be classified as a current liability in the balance sheet. 1. It is due to be settled within 12 months after the reporting date. The reporting date means the date of the balance sheet. If it is, as I have told you, the reporting date is 31/3/2020, any liability which is to be settled within 12 months from 31/3/2020 is a current liability. Second one, it is expected to be settled in the company's normal operating cycle. First time in the Companies Act 2013, what is meant by operating cycle is defined. Let us go to that a little later. That is, if the operating cycle of a company is 3 months, anything which is to be settled within 3 months is a current liability. Suppose the operating cycle of a company is 9 months, any liability to be settled within a period of 9 months is a current liability. Then, where the normal operating cycle cannot be identified, it is assumed to have a duration of 12 months. Suppose we are finding it difficult to ascertain what exactly is the operating cycle, either in terms of months or in terms of days. If it cannot be done, it is assumed that the operating cycle is 12 months. That is the maximum period for operating cycle accepted as per the balance sheet 2013 Companies Act is 12 months. The next condition, the company does not have an unconditional right to defer settlement of the liability for at least 12 months after the depositing date. That is, the company doesn't hold a right to defer it or extend it beyond a period of 12 months. The last one, it is held primarily for the purpose of being traded. That is, anything which is meant for sale or any item which is related to the item to be sold is called as a current liability. Now let us go into the operating cycle. Let us understand what exactly is the operating cycle. We are aware that any business activity can be divided into 3. One is a service provider. That means he doesn't sell anything, he sells only the services. A bus operator, a doctor, a chartered accountant, they are all providing a service for which they charge us fee. Second one is a trader. Trader is the one who buys something and then sells it as such. He doesn't change it. A TV showroom, he purchases the television and sells it. A washing machine, he purchases the washing machine and sells it. A retail medical stores, he purchases the medicine and sells it. They are called as traders. Manufacturer is the one who purchases something, converts that into something else and then sells it. Say for example, a restaurant. He purchases the urud, he purchases the rice, he converts that into a batter, makes dosa and sells it. So it's a manufacturer. So any business can be broadly classified into three. One is a service provider, second one is a trader, and third one is a manufacturer. The operating cycle of each of them is different. Let us understand the operating cycle of each of them. First of all, let us understand what exactly is an operating cycle. Operating cycle is a time between the acquisition of assets for processing and their realization in cash or cash equivalent. I purchase something, the whatever I have purchased is undergoing a process, gets converted into something, I sell it, and only when I receive the cash, the operating cycle ends. That is, from the time I acquire the assets till such time I realize the cash by sale of it. That is what is called as the operating cycle. The operating cycle varies from business to business and activity to activity. Say for example, a PVC pipe manufacturing may not require more than 24 hours. Whereas if the ship breaking activity which we are considering, it takes more than even 1 year. So it varies from business to business and also activity to activity. In case of companies engaged in providing service, there is no assets to be acquired because he is only providing a service. But in case of a trading company, the acquisition of meat means purchase of finished goods for sale. There is no processing involved. Why? Because he acquires the assets, sells it, and collects the cash. But in case of companies which are set for manufacturing activity, companies acquire the raw material, process the raw material, convert them into finished goods, and sells the same. So the activity makes the operating cycle vary from business to business. Now let us understand further on the operating cycle. Now look at a case where in a service provider the cash is available. With the cash he has spent his money on salary, etc., etc., some service is provided. Suppose the buyer of the service has not paid, it becomes a trade debtor. Only when trade debtor makes payment, I get the cash. So here cash, there is no goods. Cash, it becomes a trade debtor. Trade debtor, when he pays, it becomes cash. Now let us understand the operating cycle of a trader. The trader is having cash. He purchases the goods and he sells it. When he sells it, if it is on cash, it becomes cash. Suppose he sells it on credit, it becomes a trade debtor. Only when the trade debtor makes payment, it becomes cash. So this cash to cash cycle is known as operating cycle. Now let us understand the operating cycle of a manufacturing concern. Now look at, there is a cash. He pays it to the suppliers, purchases the raw material. He also uses the cash for payment of wages, power, factory heads. The raw material together with these inputs like wages, power and factory overheads make it a work in progress. Work in progress means the process which is undergoing the process of conversion from raw material to finished goods. It has moved away from raw material, but it has not become a finished goods. So it has become a work in progress. On further processing, it becomes a finished goods. Now he sells it on credit. When he sells it on credit, it becomes a trade debtor. When the trade debtor makes payment, it becomes a cash. Suppose the finished goods, he sells it against cash. Naturally, the finished goods it turns into cash. So there are two things here. One, a cash sale, finished goods, then cash. A credit sale, finished goods, trade debtor, and then cash. This is how the operating cycle varies depending upon the nature of activity and the business. Now the current liability consists of, one is the short-term borrowing, second one is the trade payable, third one is classified as other current liabilities, and the short-term provisions. Let us understand each one of them. The short-term borrowing can further be classified into 1. Loans repayable on demand. Loans and advances from related parties. Deposits, other loans and advances. First, let us understand loans repayable on demand. The working capital finance availed from bank is an example for loans repayable on demand. The bank has got the right to demand repayment anytime, and it is supported by a document called demand promissory note. So any loan which is repayable on demand, or I will put it in a different way, any loan which is valid for a period of 12 months from the date of balance sheet comes under this category. The second one, which I can avail it from the loans repayable on demand, I can avail it from bank, or I can avail it from any other party. Say my friends and relatives may give me, or the NBFCs may give me, etc. Then the second item is loans and advances from related parties. The related parties means the director can give a loan, short-term loan. Friends and relatives can give a short-term loan. Any group firm can give a short-term loan. Any group company can give a short-term loan. Or any firm or company where the director is a partner or a director can also give a loan. But subject to the condition that the repayment period does not exceed 12 months, such advances are classified as short-term borrowing within current liability. Deposits. Suppose I am taking I am a company selling my product through some distributors or traders. I am collecting some deposits from them which are repayable on demand. Naturally, such deposits can also be called as a short-term borrowing subject to the condition that the repayment period is up to 12 months, which comes under current liability, and any other loans and advances where the repayment period does not exceed 12 months. So, under current liability, the first item is short-term borrowing. Now, let us now move on to Schedule 3 of the Companies Act. What does it say about the short-term borrowing? The first thing is, it should be segregated as secured and unsecured. It could be possible that you know that when a company avails a working capital finance from a bank, it is a secured one because the current assets are charged to the bank. That is the stock of goods plus the trade debtors are charged to the bank. Unsecured loan could be a friends and relatives. The company has not given any security against that. So there could be secured loan, unsecured loan. So the whatever may be the short-term borrowing that is availed as per the Schedule 3 of the Companies Act, they need to be segregated and shown separately in the balance sheet. Where loans have been guaranteed by directors or others, the aggregate amount of such loans under each head shall be disclosed. In case any personal guarantee is taken, either from the director of the company or from anybody else, under the credit facility, under the short-term borrowing, it should be mentioned that this advance is guaranteed by so-and-so. Again, period and amount of default as on the date of balance sheet in repayment of loans and interest shall be specified separately in each case. In case, during the last 1 year, the company had defaulted either in payment of the principal amount or payment of interest, those details should be furnished separately. So these are the requirements or the changes which happen in the balance sheet as per the Companies Act 2013. Now here is an example. The note shows short-term borrowing secured is 166.68. Last year it was 115.39. And below that you have to write working capital availed from the bank is secured by first charge on all the stocks, receivables, book debts, and other current assets of the company, and second charge on entire fixed assets of the company. And it is already mentioned that this advance is secured. And again, it is mentioned that the advance is guaranteed by Sri Ankush Gupta. So these are the details that need to be furnished as per the Schedule 3 of the Companies Act 2013. So in case there is any default in terms of principal or interest, that also need to be added. Let us now move on to the item number 2, which is called trade payables. It is also coming under current liability. It is a total amount payable by a business for goods purchased or services availed as a part of their business operations. Suppose the company is selling a particular product. For that, the company is procuring something from the suppliers, and the supplier is permitting some time to pay, and whatever may be the balance to be paid to the suppliers is what is called as a trade payables. The trade payables comprise of trade creditors and bills payables, because both are representing the balance outstanding to be paid to the suppliers. But what is the difference between these two? The name changes, but it represents the amount to be paid to them. See, if the period extended by the supplier is within 12 months of the date of supply, the trade payables and bills payables are classified as current liability. Then we call it as a bill payable when I have accepted the bill for payment on the due date. If it is not accepted by me, it is not required to be done, then I call it as a trade creditor. Both represent the same thing, whatever may be the amount that is to be paid to the supplier. Bills payable I use only when the company has accepted the bill of exchange for payment on the due date. Thank you very much. And now let us move on. Bills payable is a bill of exchange accepted by a business, the amount for which will be paid on the specific date mentioned in the bill. Okay, let us move on to the next one. Other current liabilities. What are the other current liabilities? So we have seen short-term borrowing, trade payables. The third one is other current liabilities. It includes current maturity of long-term debt, current maturities of finance lease obligations. Let us understand the fund and two clearly. Suppose the company had availed a loan of 20 lakhs, repayable in 4 years. That means every year what is to be paid is 5 lakhs. So today the outstanding in the account is say 15 lakhs. That is, out of the 15 lakhs, 5 lakh is to be paid in the next 12 months and the 10 lakh to be paid after 12 months. So what is to be paid in the next 12 months? We will bifurcate the balance outstanding and segregate them into two things. One is what is to be paid in the next 12 months, what is to be paid after 12 months. So what is to be paid within the next 12 months is known as current maturities of long-term debt. Similarly, where there is an lease obligations, what is the amount that need to be paid? We segregate that and show it as current maturities of finance lease. Then interest accrued but not due on borrowing. Whatever may be the interest that is to be paid, but it has not become due. Similarly, interest accrued and has also become due. That also I will show. Any income received in advance, say for example, my buyers have given me an advance against some orders. So any income that is received in advance, any outstanding expenses. Outstanding expenses means zero matching concept in accountancy. The period for which the income is taken should match with the period for which the expenses are taken to ensure knowing the true profit or true loss. So suppose any salary which is payable or due within that year but not paid will have to be shown as a outstanding expenses. Any sundry creditors like a trade payable, but for other purposes other than trade, in case the company had availed any purchases or any expenses on credit, they are classified under sundry creditors. Now let us understand what is meant by provisions, because short-term provisions is one of the items coming under current liability. There are certain expenses or losses which are related to the current accounting period, but the amount of which is not known with certainty because they are not yet incurred. It is necessary to make provision for such item for ascertaining true profit or loss. A provision is an amount set aside from the business profits. When the liability is expected to be paid within 12 months, the provision made is called a short-term provision. Examples are provision for bad and doubtful debts, provision for taxation, provision for discount on debtors, provision for dividend. Say for example, let us take the case of a provision for dividend. The company had finalized its balance sheet as on 31st of March 2021. And the company in its meeting had decided that we will pay our shareholders dividend. And the payment of the dividend may take place in the month of May, June, etc. Now, I know for sure that I have to pay dividend. So, whatever may be the profit that is generated, I keep aside a part of the profit as a provision for payment of dividend. Similar is the case in case of a provision for taxation, provision for bad and doubtful debts, which I am not sure exactly, but some of them may become bad and doubtful, and provision for discounted debtors. Some of the debtors, in order to collect the dues from the buyers earlier, I tell them that I am ready to pay you a discount of 10% if I receive a payment within a period of 15 days. Such discounts to be paid at the end of the financial year, we make a provision. The company makes a provision. That is what is called provision for debtors. Now we have understood this much so far. First one is the equities and liabilities. Equities and liabilities, the first one is the shareholders fund. Second one is the non-current liability. And third one is the current liability. Now look at the shareholders fund. We have understood it is divided into equity share capital or preference capital, share application money, share warrants, and reserves and surplus. Then long-term borrowings. It could be deferred tax liability, long-term borrowing, trade deposit, long-term provisions. And now today we have understood short-term borrowings, trade payables. We have also understood short-term provisions, other creditors, etc. So with this, we have completed the equity and liabilities part of a balance sheet. And the next video, that is video series number 78, with its help, we shall continue our discussion on the company's balance sheet and understand the asset side of a balance sheet. Please subscribe to this channel to receive intimation on my new videos. Press the like button and share the information with your friends. This will also be useful to the students who are pursuing the accountancy stream 11th and 12th standard. Thank you very much.